Oh, sorry. I think we didn't have any audio there. So I was just saying that I've been trying to play around with this new webcam I bought during the week, thinking, oh, awesome, got the new webcam ready to go this week. And it wasn't working. I couldn't get it in the right spot. Then I've just had some issues with the mic. So this is the joys of going live. So if someone can let me know in the comments, is the audio working? Is the camera working? Because the joys of technology has been real fun in the last 5 minutes. So I did have a few other ideas I could bring into the show, and yeah, that's not going to happen until next week. So I'll briefly touch on that. So thanks to everyone that is joining us. So this is the episode number 6, I think we are at now, of Tax Talk Live with Ethan Rooshock. So today's topic is going to be talking about preparing for tax appointments. So I've got a few different topics around that. I've got some questions that have come in, and if you can leave questions in the comment if you've got anything you'd like answered, and I'll get to those. So what I was just saying before is I'm hoping next week to, one, be using my new webcam. It's sitting right there looking at me, really disappointing that I couldn't get it going. But what I'm going to try and do is add in some more interactive with the audience. So I'll be adding in some trivia and stuff to kick off the show starting next week. And I'm still looking for my first guest. So if anyone is interested in being on a guest on this live show, we can talk about anything finance related, tax related, crypto related. I'd love for you to get in touch with me. Send me a DM on Instagram, Twitter, send me an email. All my contact details are in all the descriptions of my videos. Get in touch with me because I'd love to have some guests, because I think that'll make it much more interactive. So like I said, today's topics is going to be about tax appointments and what you can do to prepare for a tax appointment. Do you need a tax appointment, etc.? But you can also ask questions about any kind of business related, like I said, tax related, crypto related. We're getting closer to the end of financial year, so I know questions are definitely being thrown around a lot more, and my job becomes a lot more important at this time of the year. So like I said, today's topic, tax appointments. So the first thing I'm going to talk about, which I'm going to planning on doing a full video on this topic because I think it is quite an important one, is do you need to see an accountant? And this is going to sound strange coming from an accountant, but no, not always. Not everyone needs to see an accountant. So obviously going back 10, 15 years ago, everyone's seen an accountant nearly. You didn't really have those options to do it yourself. You could do a paper-based tax return, but that was time-consuming. And most people would go to an accountant, get their tax done. So I would say over the last 5 to 10 years, especially since I've entered in the accounting world, I do feel like more and more people are doing their returns themselves, especially when the ATO have switched to the whole MyGov system and brought in the tax system that's within that. And that's really made it more simple for people to do their own return. So mainly the reason why people do their own returns is because they don't want to pay for it to get done. So that's probably the main factor that determines do they need to see an accountant, is them deciding based on fee whether they want to pay someone or not. But as an accountant, no, I don't think you need to see an accountant, but it depends on your knowledge on obviously tax and obviously your situation. So they're going to be the main two things. And then obviously the fee that you're going to pay may factor into that as well. So I'll talk first about knowledge. That if you don't understand tax and don't understand how to do a tax return, then no, you shouldn't be doing it yourself. Go and see an accountant, pay the fee, get it done properly, because it doesn't matter if you're going through an agent or doing it yourself, you're still liable to get an audit done. It can still happen. Doesn't matter if you've done it yourself, gone through an agent. And if you don't have that knowledge of tax in particular and tax laws, of how tax laws actually work, or you don't have the knowledge of actually how to complete the return, then you shouldn't be doing it. That's the basics of it. So that's first to do with experience. And then the second thing is, what type of return do you have? Is it complex? Is it not complex? Do you have investments? Do you have properties? Are you running a business? So most people that are running a business is probably going to have an accountant. That's the basics of it, mainly because it's a lot more complex. There's certain forms that are quite time consuming to lodge via paper, so you might not have access to that. And one, if you're running a business, you probably don't have the time to sit there and do a lot of this yourself. So that's why they'll normally employ an agent to come in and do that. But let's talk about an individual tax return, and it's going to depend how complex it is. So if you're working and you've got no deductions, you're just going to lodge your income, you've worked for one person, then you probably don't need to see an accountant. It's going to be relatively simple. If you can work your computer, work through the forms, read everything, you're going to be able to lodge that yourself, and you might be able to save yourself that small fee, and it might not have made much difference. If you don't have any legitimate tax deductions to claim, a tax accountant isn't going to be able to claim anything extra. So that's probably the main thing, is an accountant's only going to be able to claim what is actually being expended. They can only claim the same deductions as what you could. But the advantage to obviously an accountant is they may know things that you could claim that you might not have even thought of. So as your complexity of your return increases, that's going to more and more justify using an accountant. So obviously, if you've got investments and you're starting to have dividends and capital gains, and you're starting to go, okay, this is getting much more complicated than me just writing down how much I spent on work-related uniform, that's when you might start to go, okay, I definitely need to see an accountant. Or like I said, if you don't have knowledge of things and you don't know what's claimable. So obviously, if you don't know how motor vehicle expenses work, or you don't even know that that exists, then that's when you could fall into trouble and end up the fee that you would have paid to an accountant would have more than been offset by the extra refund you got by seeing someone. So if you work on some really basics and go, okay, say you went to an accountant, it cost you $100 in fees, then obviously you'll be hoping that if you weren't going there based on the action, you thought, oh, look, I know that. You're aiming to obviously increase your return. So obviously you're hoping they're coming up with some deductions that you didn't think of by asking and prompting you with the question. So that's one of the main roles that I have an account, is to ask those questions to go, okay, did you spend any money on this? Did you do this? And obviously they'll be based on occupation. So I'm not going to sit there and run through every single question in the tax return, but I will go through the key things for your occupation. So that's what you might not be aware of if you're doing it yourself. So it all comes down to complexity, what your knowledge is, and then I suppose cost, that can you find it at a cost basis where it's appropriate. So obviously you don't want to be going and paying $300-400 for a basic tax return if you've got $200 of deductions in total. So you want to kind of weigh that up. So then if you have decided you want to see an accountant, what do you bring to the appointment? So obviously this is going to depend a bit on whether it's your first year seeing that accountant or whether you've been to that accountant regularly. So obviously if it's the first year you're going to a new accountant, there's likely going to be some details they need to collect from you. And most accountants will get these from you beforehand, or at least make you aware of what they require. So it's likely going to be date of birth, tax file numbers, address, phone number, email address. There's some laws coming in around identification and confirming. So it might be a driver's license, etc. But they should let you know those kind of things. And then no matter whether it's a previous accountant or not, then it's going to be talking about what you actually need to complete that return. So if you've been to this person in the past, well, obviously they're going to have full details of all your old tax returns. So that's not going to be relevant. If it is a new accountant, then we are able to get some basics from the ATO on previous returns lodged. It'll be just a bit of the shell of the tax return. So we're not going to get those finer details, but we better get some details about what deductions were claimed at. So which lines you claim deductions at. We might not be able to pull in and get those details. So if you've got things such as depreciating items or rental properties, then it's going to be really important that you do bring a full copy of those previous returns. And then you're going to want to bring anything that's relevant to that year. And what I mean by that is it's going to be anything that's income related, although this might not be as important because some of this will be accessible by the accountant through what's called a pre-filling report. But still, you want to have a good knowledge of what income items you got. So it might be details of your employment income, which should be accessible by your accountant, assuming that your employer is using STP like they're meant to, single touch payroll. And then it's going to be things like interest on bank accounts, dividends. You might have especially capital gains. So if you've sold shares or sold property. And then obviously you can get into the more complex items such as rental properties, or if you've got managed fund investments, you might want to bring the tax statements for that and things like that. And then obviously details of your deductions, which this is the really important thing. So you want to have details of your deductions with the amounts. And look, it's probably best that if you're going to an appointment, if you've got the receipts there in physical copy, bring them along with you. But please total them up beforehand. It's going to save you a lot of time in the appointment. It's going to save the accountant a lot of time, and have those totals. But bring those receipts along if you've got them, just so they're there for backup if a query comes along. So that's especially important for those deductions that are over $300, because the accountant's going to need the date of those potentially, what they were for, and that's so they can depreciate them. So I spoke about that a couple of weeks ago on the live. So as you can see, it's all about being prepared and bringing as much stuff as you can that's relevant. You don't want to bring stuff from previous years. There's nothing worse than this accountant sitting down, they hand you a pile of receipts, and one's from 3 years ago, and this one's from this financial year that hasn't even happened yet. And that's when mistakes are more likely to happen, or your accountant's going to go, oh, no, I'm just disregarding the lot, and etc. So be organized. And I think the more organized you are, the more efficient that process can be, because the more questions the tax agent can ask, and rather than sorting through receipts. So total up your receipts, I think, is really important. And then it gives you a good idea of what you've actually spent. So, And then I've got what questions to ask. So when you're in the return, making sure you're asking the questions that you've thought of, write them down through the year, because quite often it will come up to that appointment and you can't remember. So if you've got questions relating to deductions on what, and it might even be what's happened in the past, it might be what's coming up in the next 12 months. So make sure you're going to an account that can answer these questions and not just there for a transactional process that it's like, oh, can I claim this? And they go, oh, they're not really sure. Make sure you're going to someone that communicates well. But ask those questions. I've got, okay, look, this is what I'm planning on doing. I'm planning on doing this course in the future. Do you think that'll be tax deductible, etc.? So ask those questions like that. And then make sure you're asking things like, oh, how much can I claim of this? And what percentages are you claiming? So you're increasing your own knowledge so that if in the future you did need to lodge your own return, at least you've got some of those basics. Or if you do swap accountants in the future, you have an idea of how things have worked, especially the more complex your tax matters. So if you do have investment properties and things like that, making sure you're asking questions about depreciation and capital works deductions and things like that, so you're having an understanding. Because quite often, if you then, like I said, do switch accountants, then they're going to ask you some questions. And if you've got no idea, it's going to make that switchover process really hard. And if you've switched for a reason, you obviously weren't happy with the previous service, or you might have moved towns, etc. And you want to make sure you're getting all those claims. So you don't want to miss out on something, because there might be something unique to your situation that as an accountant, I might not pick up on that just based on the figures that are in front of me. You might have something that's really unique. So making sure that you've got that understanding, and sometimes that understanding comes by asking questions of your accountant. So that's some of the things that I think are really important for tax appointments. And as you can see, it comes down to a lot of making sure you're going to someone that communicates with you, and that might be an online appointment. It could be over the phone. It could be face-to-face, but communication is really important, and understanding. So if you're not understanding what they're saying to you, then that's a big red flag. And that doesn't matter if you're a small individual person that's got 20 grand of income and you're just doing your small tax return, or whether it's a multi-million-dollar business. Communication with an accountant is really important. And that goes beyond just accounting. I think that's in all things in business, is that you should be able to understand what you're coming out of, and especially in professional services. So if you're seeing a lawyer, seeing a mortgage broker, financial planner, having an understanding of what they're saying and making sure they're explaining things to you in a way that makes sense to you. So I think some of those things are really important. So I hope that's kind of helped. So for those, it's good to see we have got some people watching along. So make sure if you are watching on Facebook, you hit that like button. As this thing says, look, if there's a big red banner at the bottom of the screen, you have to follow what it says. So if you're over on YouTube, hit that subscribe button, because that really helps me grow the channel. We've gone past 600 subscribers in the last week, I think it was now. So I think we're at about 630 or so subscribers. So almost 2/3 of the way to 1,000, which is really cool. The channel's really had some good growth over the last month. So I really appreciate everyone that's watching along on YouTube, or that's watched any of my videos. And make sure you do head over to Facebook and hit the like button on the Ethan Rooshock and Rooshock accounting pages. They're the little bits and pieces that you can help me. I try to put as much time as I can into this channel each week. So those things really mean a lot to me. So what I'll do now is get into some questions I was asked through the week, and then I'll get into the questions in the comments. So make sure you leave a question in the comment if you want to answer it, and I'll answer it tonight. So I've got, do you pay upfront to get a tax return done? And this is going to depend on the agent you go to. So some agents will require payment upfront before they even start the process. Some will require it before it's lodged. And then you will get some that will take the fee out. So some will refer to this as a fee from refund service or a take fee. So pretty much in essence, they're going to take their fee out of your refund. So not all accountants offer that. I know personally at the moment I don't offer that service, purely because it's quite time consuming. It causes risk that, if you don't have the refund and it goes to elsewhere, so the ATO might take it, that's going to then result in a debt collection process, etc. So it would just depend on the tax agent. But make sure you ask the question so that you're aware, because I do get people come into an appointment and it's when it comes to pay, they go, oh, I thought I didn't have to do this. So I try to make it as clear as possible in my business what my payment terms are. But make sure you ask that question when you're booking, if it's something that is important to you. Go, look, do I need to pay for this service up front? So ask that question when you're first booking your appointment, because they should be able to tell you that. So then I've got, how much does it cost to get a tax return done? And this is really going to vary so much depending on the accountant. So I know for this year, we've set our prices and they're going to remain the same as they have the last 2 years. So it'll be $79 for a tax return. And that just is for a basic tax return. There's extra fees then for rental properties or capital gains events, etc. Or if you're running a business, but that's our basic fees this year. We're going to go up $79 again. That's inclusive for GST, but that's going to vary a lot. So I've seen tax returns as cheap as $50, $60 mark, and I've seen ones that are probably up around that $200 for the same service. It's just going to depend on what the business is. So a lot of accounting firms are going out of wanting to do individual tax returns. So their way of getting out of them is to hike the fees. So if you want to pay for it, then they're going to collect more money off it. That's just the reality of it. So if you're only caring about fees, you can shop around, but you should be looking for service probably over fees, because like I said, what's saving $20 if that person is not going to communicate to you or could significantly get you to reduce refund because they haven't asked the questions and haven't taken that time. So I really don't think cost is all you're looking for at an accountant. I know that is what some people are looking for, but I really think there's more important factors than just the cost. But at the same time, don't get ripped off. Don't go and pay $200 or $300 for a basic tax return if you're not getting an enhanced level of service. If you're getting a 10, 15-minute appointment, you shouldn't be paying that type of level. That's just my opinion, but that's just something to keep in mind. So I've got how long before you get your group certificate, and do they still come in paper form? And well, group certificates don't actually exist anymore. They haven't existed for a long time, but that's what they'll commonly be referred to as. So they did get changed to payment summaries, has been the terminology used for quite a while. And then they've been changed again with the introduction of single touch payroll. And I believe they're now called single touch payroll income statements. So you can normally see this on your MyGov account, and the tax agent will be able to see this on the ATO online services system. So I can go in and see what's been filed for the year. So pretty much your employer has to file your income every single week or fortnight, depending on your pay period. And this gets filed directly to the ATO. And then through the year, you can actually see what you've earned year to date and what you've had tax taken out year to date and what you've also earned with super. So they're not called group certificates. And no, they don't still come in paper form. And quite often you don't get a copy at all because they're going straight to your MyGov account. So when the employer finishes the financial year off, they finalize it with the ATO. So that's the key thing, is the finalization of it. And so this is meant to happen within a certain time period. It's going to depend on how big the employer is, a few different factors like that. But they have to be finalized first. So you'll be able to see it on your MyGov account, or your tax agent will be able to check this to see if it has been finalized. And look, I honestly give it probably 2 weeks in July, 2 to 4 weeks, it'll be done. There's certain, like I said, there's certain deadlines. Not everyone seems to meet those deadlines, especially since this is still a new system. But you can check this yourself on your MyGov account to see if it's finalized. Don't do your return until it's finalized. This is really key because it means they haven't actually finalized these figures, even though they may look correct, and most of the time they might not change. But you want to make sure that's finalized first before you do it. So like I said, 2 to 4 weeks probably in July before you'll be able to get your return done. But it's just going to depend. Some of them are finalized pre-30th of June. Just depends on when the final pay for the year is. So that's another thing to keep in mind. It's going to go off your final payment date. So if you get paid and it physically goes in your account on the 30th of June, that will fall into that year. If it's the 1st of July, that'll fall into the next year. So it's on payment date. So that's just something to keep in mind. So that leads well into the next question. So when is the best time to do your tax return? So honestly, it's going to depend on what's involved in your return. So a basic return where you've worked for one person, you know how much it is, you know when that's going to be done, you're only waiting on one thing, then that's easy. That's going to be, okay, as soon as that's finalized, you may be able to do your return. Now, it gets more complex, obviously, if you're running a business or if you've got investment properties that you're waiting on statements, or in particular managed funds. So they have to issue a tax statement. So if you've invested in things like ETFs as well, those kind of things, you're potentially waiting on statements, etc. So you want to make sure you've got all of that paperwork in place first before you do your return. So again, look, honestly, probably don't rush out and do it on the 1st of July if you're waiting on stuff, because it's going to be a stop-start process. If it's not done, then you're going to be going back and forth as an accountant. You're going to be back and forth on your MyGov, or you end up lodging with incorrect information. So it's just going to depend on what it is. I'd say, look, normally you probably want to give yourself a couple of weeks in July for things to flow through, make sure that the systems are all working, make sure. I've seen it before where banks have submitted the wrong interest amounts, or people have filed their STP reports and then gone, oh, hang on, they've made a mistake and had to reissue them. So normally you want to give yourself a couple of weeks in July. I know people are quite often really wanting those refunds back as quick as possible, but you just want to make sure you've got all that information first, because you don't want to be doing an amendment. You don't want to potentially be getting charged for an amendment. So get your information and make sure it's right before you file it. What are some things that can be claimed on tax? So this is a very broad question. So look, there's a lot of things that can be claimed on tax. There's a lot of things that can't be claimed on tax. It's going to depend on your occupation, what you're doing, how you're earning your income. It's going to depend on how that income's earned, and then is this expense related to you earning that income, and was it required? So there's quite different laws depending on what kind of deductions we're talking about. But that's really what you want to start thinking about. Was it for work, and did I need it? So you want to be going, okay, look, I have to get this license, and that is required by law. I need that license for me to be able to do my job. It's a term of my employment, etc. Well, that's obviously going to be deductible. But you might be going, I did this, but no, it was really personal related. But no, that's when you're going to start to get into trouble. So you want to make sure it's really got a clear connection between the earning of that income and the deduction. So that's where people get caught out. And like I did speak about it last week, and they're trying to extend some of these things, but like just because you're studying, people quite often go, oh yeah, studying, I can claim that on tax, but it's not always going to be the case. It's going to depend on, is that related to your current job, etc. Same with the biggest one that people get confused on is motor vehicle expenses. So thinking that travel to and from work is deductible, which it isn't. And it doesn't matter how far you're traveling. It doesn't matter if you're flying to your job. That's not going to be deductible. So there's lots of different things. But the easy thing is to do a search on the HO website on the topic you're searching for. You should be able to get some kind of guidance, and then ask those questions to your accountant when you see them. So it depends what it is. Search that thing. So clothing related, there's lots of articles, for instance, on uniform, on what's deductible, what's not. And there's normally a lot of good examples that you can see. Then you go, oh, mine fits into that exact example category. So that's a good way to look at it. So I've got another one here is there an easy way to estimate your tax return before you get your tax done? And well, this is going to depend on, obviously, again, how complex it is. So a really basic way to do it is work out what your marginal tax rate is. So I'll bring them up for you in a second here. I'll search that one up. But that's going to be an easy way. If you know what your marginal tax rate is, then it's going to be really easy for you to do a real quick estimate on your tax return. So I'll bring it up here. Just bear with me a second while I share my screen. So this will be so I've got the 2021 year rate, so that's the current year that we're in. So you can see the different marginal tax rates here. So we've got 19 cents here, 32.5 cents, 37 cents, and 45 cents. And then we've got the 2% Medicare levy as well. So what you can think about it here is to go, okay, I've got a deduction and I'm on the 32.5 cents bracket, which is what a lot of people fall into. So that's between 45 and 120,000 of income. And I've got a $100 deduction. Well, then at the real basic estimate, you can go, okay, I'm going to get 32.5 cents per dollar for that back. Plus it's going to be the 2% Medicare levy. So that $100 deduction should get me about a $34 refund for that deduction. So that's a really basic way to think about it from a deductions point of view. And then obviously when you're thinking about things like from a overall return, do you mean how based on how much tax you've paid for the year? Then there are some calculators you can go online. So I know a really good one is Pay Calculator. So that one there, you can put your earnings in for the year. Again, look, these, if they're not on an HO website, you do run the risk that these are third parties kind of thing. So that's a risk you've got to take. But some of these are really good. So I might share Pay Calculator with you as well. So that's just a really simple one that I've used before just to get some real basic estimates. So you can use something like that where you can put in your total income for the year. So we've got Pay Calculator here. So you can put your total income in here. And then what you can do is you can go down and it will give you all the different options. So you can put spouse income, for instance, with super, without, student loans. And then what it's going to give you is the tax for the year based on that income. So I suppose you could compare that then to what tax you've actually paid. I think you can actually now put your estimated deductions in and stuff like that. So again, some of these tools make it kind of cool that you can get some kind of estimate of a return. So yeah, there's different ways. I think the ATO do have a few calculators on their website as well. So there's lots of different ways you can get a basic estimate. Obviously, until you get the final do you mean final notice of assessment from the ATO? That's when it's going to be finalised. So, yeah, that's just some basic ways you can get some estimates. So it might be a good idea to do some of that before you go into your appointment with your accountant. So you've got an idea of, look, how much am I actually going to be getting back? And then when it comes back, to at least you've got some idea, because there's nothing worse than going to an appointment going, oh, sweet, I might get 3 or 4 grand back this year, I think, and you've just estimated that off the top of your head, or the bloke down the road, he got that much back, and then going, oh, I only got $300 back, and then feeling like the accountant didn't do a good job when it might not be that. It might just be based on your current situation. So I've got one more question that was answered through the week, and then I do have a couple there in the comments, which is good. So make sure you leave a question in the comments, and I will get to them in a second. So I have this question here come in, and it was, how long can capital losses be carried forward to offset future capital gains? And so there isn't a limit on this. So if you have a capital loss in 2020 or 2021, so that capital loss, and you've got no other gains in that year, so that might be you've sold a investment property and it's in a loss position, or you sold some shares, or you sold some crypto and you've made a loss, you can keep rolling that forward. Make sure you make either making your accountant aware or checking, or if you're doing that, make sure it is rolling forward in the return so it is recognized. So I've seen that before where people haven't rolled it forward. Most software should be rolling it forward automatically, but you've got to be careful, especially if you switch accountants. So again, these things should be picked up, but so you can keep rolling that forward. It might be 10 years later when you have a capital gain event, and then you can offset that loss. So it is good for capital losses in that regard. So for instance, if we've bought some Bitcoin, for instance, and it was in a loss position, I sell it today, and then in 10 years' time, I'd held, it might be a property or it might be shares, I can offset that loss. So you can just keep carrying them forward. There isn't a limit. So it's quite a simple question there. So, yeah, so that was all the questions we got asked through the week. So I'll get into the ones in the comment in a second. But if you do want to ask questions during the week, you can send them to me on Instagram, on Twitter, leave a comment on a YouTube video, and I will answer them. So the first question we had here in the comments is depreciation in business effectively claiming the cost of an asset twice? No, it's not. So I'll quickly get into that. So depreciation, for those that don't know, it is relevant for business and for individuals, but pretty much it's when an asset is claimed over a number of years. So if you think of something like a phone bill, you claim that full deduction in that year. But if we talk about something like a car, it's likely going to be depreciated. Now, it's going to depend on what the current rules are and how you're operating, etc. But say it might be claimed over 5 years, and normally they'll be on like a diminishing value system. So that's where the claim will be higher in the initial years, and then it will reduce as we go through. And I think that's kind of how a lot of assets devalue. So that's kind of where depreciation comes from, is that an asset devalues over time. And say, look at something like a car, it loses a lot of value early on and then less in other years. So that's pretty much what depreciation is. There's different depreciation rates for accounting and for tax. But no, it's not claiming the cost of the asset twice. The reason for this is because it won't be claimed. It's not like you claim it in full and then depreciate. You will do one or the other. So if it's claimed as a full write-off, then you're not getting future claims. Or if it's depreciated, you're not getting that full write-off initially. Now, potentially if you are registered for GST or something like that, you may be getting an upfront claim, and that may be different to what the GST, to the depreciation is, but you're never going to claim something twice. That'd be great if we could claim things twice. That'd make my job easy, because I go, oh, yep, sweet, we can claim that upfront and over time. But no, you're not going to claim it twice by depreciating. That's not how depreciation works. So we have a question here. So yeah, thank you. I appreciate that. Great work on the live stream. Really appreciate it. I appreciate everyone that's tuning in, watching. It's been good. The last couple of weeks, we've had more consistent viewers throughout the whole thing, and they've been split across Facebook and YouTube. So I can see the ones that are tuning in. I can see that you're there. I can see you've hit that like button. Really appreciate it. Thank you. And so I've got a good question. What would be the most tax-effective structure for investing in shares, both here in Australia and overseas? So good question. So I have done a video in full on my channel talking about investing in a different type of structures. So just a quick one, we can invest in our personal names or as a sole trader, depending on kind of what you structure. But personal names, you can invest within a partnership, or it might be in joint names. So it might be husband and wife there. So it'll depend whether they have an actual partnership set up, which is more so going to be used in business, but could be used for investing, or whether it's just in joint names. So you might have shares that are held in joint names, or typically an investment property. And then you've got trusts. So there's different types of trusts. We've got discretionary trusts, fixed trusts, and things like that. And then we've got companies. So there are a few different options. And what I think my biggest advice is, look, everyone's situation is going to be unique. You're really going to have to get your own advice on those things. But don't just set up a complex structure just for the sake of it. So I think some people get caught up in thinking that, oh, I've got a company and I've got a trust, and that sounds really smart and that's going to save me a lot of money. And Bob down the road, he's got a trust and he's got a company and he saves heaps of money. So don't get caught up in that, because it's not always. You don't want to be paying fees or extra, and it might be extra upfront fees. Companies come with extra ongoing fees. You might have legal fees if things change, or you might have ongoing extra accounting fees. Might be extra software fees because you're running multiple entities. So if all these things are adding up and you're not getting the benefits because it might not actually be saving any tax, well, was it worth having that structure? So that'd be my first thing, is that don't just set up another structure just for that. So the most tax effective structure is going to depend on things like, so unfortunately I can't just say, look, yeah, do a company, because that's not always going to be the case. But some of the things you want to think about is going to be things like, what is your other income? So if you've got employment income, which is typical, or what's your situation in regard to who would be beneficiaries to this? So is it just you, or is it you and your partner, or have you got kids? Now, what are the ages of the kids? Have you got parents that aren't working? And then it goes another layer on top of that. Is, okay, you might have parents that aren't working, but they're on an age pension. So then would distributions to them affect that? You might have kids that are over 18, so they may be able to receive full distributions, but they may have HEX debt. So there's always going to be multiple layers to these things. And that's why everyone's situation is going to be unique, and making sure that you're going someone that understands that and isn't just selling you, because quite often people will set these structures up because it's a good money thing. They charge you up front for fees. They charge you more fees ongoing, and they sell you the benefits. They go, yeah, you're going to save $1,000, but they don't tell you it's going to cost you $800. So they don't go, oh, so you might still be better off if you buy $200, but they didn't tell you about that $800 cost. So they're promoting it as a $1,000 benefit when it might only be a $200 benefit. So yeah, there's some of the things that you need to keep in mind of, look, what's going to work best for my situation. So you might be a really high income earner, and therefore you might go, you know what, I've already got $200,000-$300,000 of personal income. I'm going to invest through a company. That company is going to hold those assets. That company is going to pay a lower rate of tax. So it might be that 27.5% or 30% tax rate, depending on what size the company is, etc. And then I can pay those out as dividends to me when I retire, and I'm going to get franking credits. So that's where a company structure might you might, but obviously there might be downsides to that, like no capital gains discounts. Then you might go, okay, a trust structure could work well for some people. So in a situation where you might have, like I said, husband, wife, they might have 2 adult parents that aren't working. They might have 3 children that are over 18 that are still working part-time jobs. And suddenly you might have 5 or 6 people you could distribute to. And therefore your dividends and your investment income could be distributed multiple ways, and that might be a lot more tax efficient than you, who might be a individual worker who might be on $250,000 on those really high tax brackets. So that's where that kind of structure could work well. But again, it's going to really depend on lots of different situations. And there could be some situations where, investing in your personal name works best for you, because honestly, for all the fees you might pay, that just might be the best solution. So don't get sucked into just setting up another entity just for the sake of it, because you want to weigh up fees versus expected tax savings. But in saying that, there is more to it than just tax savings. So it could come down to legal protection, might be generational wealth that you're trying to achieve through passing down assets through multiple generations, or it could be investing on behalf of children, which is something I want to talk about in a future video. So more of an advanced topic there, but there's lots of different reasons why you might set up another structure. So we also have another question here of, we have a self-managed super fund all set up, and I'm pretty sure we get taxed on 15% on any gains within an SMSF, but would like to keep a portion outside of our SMSF. So that's going on from that previous question. So again, we're starting to get into complex matters here, but you can see this could be another option that people go, okay, I want to invest in. So they do set up a self-managed super fund, and yeah, there's going to be definitely some tax benefits there within the fund of what like you're talking about here, of what the tax rate is on earnings within that fund. But again, you want to make sure that if you're going to then invest outside of that, does that fit in with your overall strategy? So again, that's where it can come down to, like I said, checking those things of checking what your current situation is, what your earnings are, what legal protections you're looking at, who the beneficiaries will be. All those kind of things are really important when picking the right structure. So definitely recommend getting some advice. And it might be not only accounting advice, you might want to get some legal advice depending on how complex and what your reasons are for it. So once you identify those reasons, you can identify what benefits you're looking for. So I really appreciate those couple of comments. It's a really cool topic to talk about in depth. So yeah, it gets quite complex when we start talking about self-managed super funds. That's getting a quite in-depth topic, but yes, definitely fun stuff to talk about. So I appreciate everyone that's been tuning in. So that's been a pretty good night. I think we've had some good questions come through there through the week. Had some good questions in the comments. Had lots of people viewing, which really means a lot to me. So I will hopefully have another video coming up on Sunday like I normally do. I can't remember the topic off my head. I do have a whole list of topics that I'm doing videos on. So, and just before I go, I appreciate the good word. Yeah, I will be talking about, like I said, investing on behalf of kids and stuff like that, because I know that's a topic that a lot of people want to talk about and want to hear more about. So that is something I can talk about and just give you some more. A lot of my videos are giving you some ideas on where you need to investigate next. So I will say some of these questions that come in from the Adventurous Investor, he has a really good channel. So I'd really highly recommend anyone heading over to his channel, check it out, hit that subscribe button over there, because again, you want to see there's lots of really good content creators out there in the personal finance world, and he is definitely one of them. So head over there to his channel, and I appreciate the support. I appreciate everyone tuning in to watch, and hopefully I'll see you again next Wednesday night, same time, and make sure you send those questions in through the week. Check out my podcast, so head over to Spotify, Tax Talk with Ethan Rooshock, and if anyone can come up with a better name for that, then I really appreciate that. Thank you again, and I'll see you all soon.